Alrighty boys, so today it's a little bit different because I saw that some of you guys wanted to know how I trade and just give a basic rundown on how I do my analysis and everything. And since that was the case, I figured I would just make a little video about it. So I actually ended up going through yesterday as an example, but I don't think that was really that great. I don't think the quality was as clean. So I'll just go back and redo it. But yeah, coming into the Confluences, the main confluences that I look for when I'm trading, one is liquidity, another is fair value gaps, another is order blocks. Those are like the core ICT supporting imbalances or supporting levels. So I think most of you would know these things. I also use the Fibonacci tool, and I also use discretion and timing. So these are the things that I will be going over today. Looking at, say, liquidity. Liquidity has, so there's two types of reactions price can have to liquidity. So liquidity is essentially is a swing high or a swing low. And there are two reactions that we can have to liquidity, which is reversals and continuation. So those are the two reactions that we can have from liquidity. So let's go through an example. So let's say in a bullish case scenario, we have this strong liquidity. A continuation would be price pushing and then getting a rebalance, let's say, and then we break past the swing high and then we end up rebalancing and then displacing higher again. That is a continuation. And there will be a reversal where we come close again, we rebalance, we take out the swing high, but it's a weaker. So I'll go over this in a little bit, but there are these characteristics that we can see from price taking out liquidities and price reacting to imbalances that we can use in our favor. And that is essentially narrative. That's what I talk about in my videos when I say narrative. But yeah, a weak take of the swing high where we then displace lower, rebalance, and then we form lower again. That is a bullish reversal. So this is a bullish continuation and this is a bullish reversal. And same thing for bearish situations. So this would be a bearish continuation where we displace lower, rebalance, and then displace lower again. And for a reversal, we would come down, rebalance, and then displace past it, weak form, and then displace higher, rebalance, and then displace higher. So that would be a bearish reversal. So yeah, these are the two ways essentially that price can react to liquidity. And this ties back in with timing with liquidity, but essentially what we want to look for liquidity, because there's always going to be a lot of liquidity. So you might be wondering which ones we'll be focusing on primarily, because how do you know which liquidities will be higher probability? So what I look for is essentially higher time frame liquidities and how price is reacting to those liquidities as well. So we want to see how price is reacting to higher time frame liquidity, and then from this can help determine our narrative or our directional bias for the day. So this is essentially why we use higher time frame liquidities. Another drawn liquidity that would be prominent is timed liquidity. So primarily pre-market highs and lows, and then the session highs and lows like London and Asia. So these are the primary liquidities that we want to look for and see depending how price reacts to coming into the day. And then from those, we can then see how we want to see price move. So yeah, that's essentially liquidity. And we'll move on, we'll cover all of these confluences, and then we'll go over the example that I went through before. But for fair value gaps are essentially a free candle pattern. Yeah. So let's say we have let's change it to fair value. Okay. So let's say we have bullish candles, right? Bullish candles like that, and like that. It's a free candle pattern, essentially. And these candles will also have wicks as well. So let's say this is a fair value gap. This gap here from the top of the bottom, the top part of the wick of the bottom candle to the bottom part of the wick of the top candle, that range forms the fair value gap, and that's what we're looking for. So if the wicks overlap like this, then I wouldn't really consider this a gap, but I think it depends how people can look at it. I know recently I've been looking at fair value gaps as more of a 2 candle pattern. This is a little bit more niche for you guys. essentially my read on narrative is really strong. I'm just going to assume that this is going to open up into another fair value gap. So I'll consider this a fair value gap, and then I'll wait to see how price wicks into it, and then how price displaces away from it. And then if we displace away from it, then I can just take a long like this, stops below displacement, and then targeting whatever target I want to go for. So that's a way that you can use fair value gaps. I wouldn't really recommend this way for beginners mostly. I would just recommend the way that I did it before, where it was just, you know, like this, and then we had like from the top of the wick to the bottom of the wick. And yeah, that's essentially a fair value gap. And what fair value gaps do for us is that we want to see price rebalance into them before displacing higher. Those are the primary uses of fair value gaps. And it's pretty much the same thing for order blocks as well. I'll go over order blocks in a bit, but essentially their goal is pretty much the same, where they're going to be supporting levels for price, right? And I'll go over a bit of the characteristics as well, since it's a good time to go over it because we're going over all the confluences. But for characteristics, we want to see how price reacts to the relevant confluences, right? Primarily with the liquidity before, what I was talking about was, let's say swing high. Sorry, I'm going a little bit back and forth, but like, let's say a candle opens up very bullish. Okay, candle opens up very bullish, and then it's like that, right? This would make me think that it was like there's little wicks, and there's like, yeah, barely any wicks, and then we just form strongly past the swing high. That would give me more of a narrative that price is going to continue higher. So from there, I would just wait for price to rebalance with a wick and then displace higher again. And then if your discretion is really good, you can probably just take it from the retest and then target swing high. Then it stops below displacement, something like that. But then if it was weak, let's say it's like this, weak form, and then we have a strong wick, right? This is showing to us a lot more weaker power, and from this we want to see how price is reacting to this swing high. So let's say we just displace lower, right? We just displace lower instead. Then you're going to be glad that you waited for price to react, and that's why we wait for the characteristics of price forming to these swing highs and lows. So with this one, since it was so strong with the body, and let's say the narrative is lining up for more bullish, then you can assume that this is going to open up more strongly as well, because we want to see a continuation of the bullish structure. But if we had, let's say the day was more mixed and we don't really have a set bias for bullish or bearish, then we see this kind of weak form at the swing high. Even if the body form passed, if the wicks are strong, we want to wait to see how price reacts to these types of draws. And then yeah, sometimes the price will displace higher, sometimes it'll displace lower. But even if there's like a move in there, you're going to be more happy that you waited, because I think it's a little harder to predict these things, and you don't need to predict these things as well. That's the primary thing. You don't need to know always where price is going to move, and it's okay to just wait and see. And then if a setup runs by you for one day, then that's okay. We can just come back tomorrow for the charts, because the charts will always be there, right? But yeah, let's say for the characteristics of a fair value gap, primarily what I would want to see if we're strong for bullish, right, is that we retest into this fair value gap, and then we don't even like leave bodies, right? We just form a wick and then we just displace higher. That would be the cleanest form of a fair value gap, and that would give me a lot more confidence for a continuation higher. But let's say we displace lower and we actually form a body past, let's say, the 50% of this fair value gap. If that was the case, then I would be a lot more cautious and I would wait, because that is showing to me that price is more than likely going to disrespect this fair value gap. So that's why I always have this middle line of the fair value gap marked up, because it's a very useful tell on the characteristics of how price is going to react to the fair value gap and the order blocks. Let's say we just displace lower past it, then that's just like, you know, we're inversing this fair value gap, and then we're just going to wait to see how price reacts again. If we rebalance and displace lower, then you can take a short. If we rebalance and then we displace higher again, and then we have the bullish structure, we displace higher, and then we like chop and shit inside this and displace higher, then that would show to me that we're more bullish, and then we can take it from this displacement leg higher. But yeah, that is essentially the characteristics of how price can react to a fair value gap. Oh, sorry, there was one that I forgot. It was price chopping within this. So let's say like we're in a bullish case scenario, and we want to see price continue higher really fast and really strong. If that's the case, I don't want to see something like this form, you know? I don't want to see chop forming into a fair value gap, because this chop would signal to me that price is failing to continue higher. We're lacking bullish structure, and since that's the case, I'm going to be assuming that price is more than likely going to displace lower and move in the opposite direction. Essentially, that is how price can react to fair value gaps. So I'll just write that down for you guys real quick if you guys want to like write down any notes or anything. So T. And the thing is with these things, the more you look at the charts and the more you show up each day and you analyze, the more easier it'll be for you to find these things. So yeah, for order blocks, this was a little interesting to explain before, but order blocks are essentially, they're more for reversals, right? Another bullet, oh no, let's switch it up. Let's do a bearish case scenario. So we displace higher and then we actually wick out this low, and then we displace past this low. Oh no, displace past this high, we soup it, we displace lower, and then we go past this swing low. That is what primarily forms an order block. Let's say this is our order block. So the order block is essentially the candles are moving in the opposite direction. If we're engulfing it, right? So let's say these bearish candles are engulfing these bullish candles. These bullish candles only take up this range, and the bearish candles take up this entire range. That would be an order block. And you don't want to really see any like breaks in it either. So what's an example? This range, right? I wouldn't really consider this an order block. I would be considering this one candle as an order block, because you can see we actually ended up retesting into that one perfectly, and then we displaced lower from there. But yeah, that's just like a nitpick example. Primarily what we want to see with order blocks, as you just saw, is that we want to see price rebalance and then displace lower, just like fair value gaps, or displace higher. However, the trend is for the current day. For order blocks, I use these supports for the higher time frame, the 15-minute and 5-minute. So I just use them more so to line up the time frames. So an easy example I can say is like, let's say this is an hourly order block, right? If I zoom in, then I can find that there will be a 15-minute order block over here, and then there'll be a 5-minute order block over here. And then because of that, I can now see that this darkest area is the more prominent area that I want to see price retest into. Because of that, I can just remove the hourly, and the 15-minute, I can just target this 5-minute, right? And then that's how you can find accurate order blocks and fair value gaps, because you can use this with fair value gaps too. And then we want to see, yeah, price retest into that prominent one, and then just displace lower. That's essentially order blocks. The next one is Fib tools. So I use Fib tools for the golden zone, or OTE as I call it in my videos, and then also the equilibrium. But like I use this as a support for if I want to like back up my entry a bit more. So I would be marking out like this range. So let's say this is coming into pre-market and then market open, and I can take a trade around this time. We end up forming an order block, right? Let's say we'll use this 5-minute order block. But then I'm questioning it a little bit. Let's say, what can I do to give myself more confidence in this? I use the Fib tool. I mark out this high, like the displacement range essentially, and I want to wait to see how price reacts to the essentially like the 50% and then the OTE, because the OTE more than likely it'll be met. I would say maybe like 6 or unironically 6 or 7 times out of 10, right? But equilibrium more than likely not for a trade, then it will be met. So essentially, like you'll use this 0.5. You want to see price react to the overlap of the OTE, the equilibrium or OTE, along with the order block or fair value gap. It doesn't always need to be OTE. It can just be equilibrium. I've seen a lot of people make it work with just equilibrium, so you don't need this. And price retested into this order block and displaced lower. And then another thing I forgot to go through for fair value gaps is that I use 1-minute inverses for confirmation. So let's say, I'll just go over it now, but primarily what I'll see coming into these types of trades is that price will retest into like OTE of, okay, let's say this entire range is the order block, right? We retest into the order block, we also retest into the OTE of this. And what would give me the confirmation for my entry? It would be a 1-minute fair value gap. In this case, it would be bullish because it would be this leg up over here. And we see a fair value gap, and then we see it get displaced through. And then from there, we rebalance and then displace lower again. That is pretty much my entry model for me taking these trades. A lot of times, if my narrative is strong, and I'm really happy with how price is looking. It's aligning really nicely for 4 hour, 1 hour, 15 minute, 5 minute, and 1 minute. Then from this inverse, I'll just take the trade. Stops above this prominent high, and then targeting standard deviation or just a 1-to-1 internal low, anything that works for you. But you can also, if you need more confirmation or you want to wait for a bit more confirmation, you can wait for price to rebalance and then displace lower. Then you can take it off the rebalance. Stops still above here until, because we need to account for price taking out internal manipulation, right? That's what you're accounting for. But then once we start displacing lower again, then you can trail it and then move it to break even. That's what you can do. So yeah, that's pretty much my entry model for how I trade. And Flip tool, yeah, Flip tool is just a bonus little thing to add on. You don't really need it with all these other things. Yeah, timing for when I trade. So I want to trade during the most optimal time. The times that I usually trade, I start my session 15 minutes prior to market open. That's when I can start trading. And I don't trade 30 minutes past market open. So I give myself a 45-minute window because I don't want to be on the charts all day. So I trade at nighttime. I trade in Australia, so I have work usually in the morning. And because of that, I don't want to spend too much time on the charts. But yeah, we ended up, let's say 15 minutes prior to market open. I found that before, when I entered anywhere prior to this, I would more than likely be stopped out. That was also probably because my entries were shit back then and I didn't know narrative as well as I do now. Obviously, I'm still learning right now, but I can tell that I've improved a lot from before. But yeah, 30 minutes past market open, that's more of a personal preference thing, but it can adjust for you guys. But I would say no longer than like an hour past market open. After that, I would say that price becomes a lot less probable because markets or like the volume starts dying off. Yeah, that's pretty much timing essentially. And then the time frames that I use primarily is the 4 hour and the 1 hour for the high time frame. Let's mark it out. High time frame is the 4 hour and the 1 hour. The low time frame is the 15 minute and the 5 minute and the 1 minute. And I use the 1 minute, I use it for confirmation if I'm looking to take an entry. And then the 15 and 5 minute I use for analysis. 4 hour and 1 hour I use to determine my directional bias and my narrative, and for more confidence in aligning the narratives. Yeah. But I haven't gone over the most important thing, which is discretion. Discretion is so important. I can't stress to you guys enough. Like discretion, if I want you guys to take something away from this video, it's discretion. Like discretion is possibly the most important thing that I've learned so far in my trading journey. Because you can have all of these confluences above and it still would be hard for you if you didn't have discretion and you didn't give price time to develop and you didn't show up to the charts every day to develop this discretion. And what I mean by discretion is that we don't want to pattern trade these confluences. Like let's say you see a fair value gap form and you just enter it from the rebalance because you're expecting, oh, it's a bullish fair value gap, we want to see it continue higher, but then we just displace lower and we shit the bed, right? That's not what we want to see. And that's not the type of trade that we want to make. We want to wait for price to rebalance and then displace higher. Then we can take, okay, let's say it's like this. Then we can take a trade from the displacement targeting the high that we just developed, like this, like that, right? So that's why waiting for price to do its thing is really important. And discretion is like, I think as you develop as a trader and the more you trade, the more you'll be able to recognize these little intricacies in the market. Like, okay, let's say something like this develops, then even before like the order block forms, you already entered here and then we just like shit the bed there. And then you caught this entire move. Like that's how people can find these like high risk to reward trades. Right, they build up a bunch of discretion over time and it looks like a low RR trader suddenly bursts out with higher risk to reward. It's because they built up the discretion and then they built up a lot of confidence over a long period of trading. That's essentially why discretion is so strong. And yeah, using that discretion to know when you can trade, know when not to trade, know when to actually execute on your setups, that's what we use discretion for. That's pretty much everything for the model. So I'll just go over an example from yesterday so you can see I already did a little bit, but yeah. Okay, looking at the hourly, yeah, it's like overlapping everywhere. So let's go over the higher time frame. The hourly coming into today, we actually took out this swing high, like this prominent swing high. This is market open, and then prior to market open, we took out the swing high with a strong body form past. Yeah. And then from there, I would scale down and I would want to see how price is reacting. So you can see here, we completely bust through this 15-minute fair value gap. And from there, like, we didn't have anything past here. You'd be like, oh, like, what do we do? Because it's like, what the fuck do you do if it's conflicting? If that's the case, you just wait. You don't need to know, or you don't need to be able to tell how price is going to move if it's conflicted. You don't need to trade when it's conflicted. You can take a trade when price starts aligning. This is why you don't pattern trade these things as well, guys. Like, we displaced lower past this 15-minute fair value gap. Let's say you took it off the 15-minute inverse, stops above here, and targeting this internal low. That's still going to shit the bed, and you're still going to lose the trade. And that's because, like, we shouldn't have pattern traded this. We still need to wait to see the reaction to your price retesting into this inverse, and then we want to see how price displaces past it. And that's the important thing. So if we zoom in even closer, we can see that this actually formed a soup on the 5-minute, right? And this soup, this wick sweep of liquidity, shows that we have weaker bearish power. We don't have the power to continue lower, to form strong bearish candles down. And that's why we still align more of the hourly, like, bullish bias, right? And let's say, so we'll write down the Confluences. So hourly, we have a strong body form past swing high, and then 5-minute has a soup of a low. And then if you remember, waiting for the characteristics of how price reacts to the Confluences, we have a 15-minute fair value gap being accumulated in. And if you remember what I talked about with price accumulating within bearish Confluences or bullish Confluences, like the fair value gap, is that if that's the case, we're more than likely going to inverse it. And that's what we actually ended up doing. So we can ignore essentially this fair value gap for now. We have the soup, we have the hourly form past, and then if we zoom in even closer, because now I'm waiting for confirmation, it's getting closer to market open, so I want to take a trade. I don't need to force a trade, but this is aligning pretty nicely for bullish, right? What ended up happening after we accumulated in this 15-minute, I don't need to see like an inverse fair value gap form fully now, because we have the hourly, we have the 5-minute, and then from this, we have the 1-minute. We have a soup of a low again. We form an order block from these bearish candles gets engulfed by these bullish candles. Because of that, it forms this order block. So we have a 1-minute soup plus order block. And then because of that, I don't even need this 15-minute, right? I don't need this 15-minute. I can just take it from here because we ended up forming this order block. We rebalanced and we formed past the swing high. Even though this body form wasn't that strong, to be honest, it's not the cleanest. This is why I would say a lot of people would hesitate with this, and I hesitated with this too, actually, on the day. I didn't end up taking this trade, but I know since we have all those Confluences prior, like the soup, the 1-minute order block, the 5-minute soup, the hourly strong body form past, we can then take this trade targeting the swing high, right? It doesn't even need to be swing high. It can be this internal high, it can be 1-to-1, it can be, I don't know, this internal high, but there's a pretty bad RR. So yeah, that's essentially how you like formulate your narrative into taking a trade. And then from here, like this is a little bit later, but if we actually go in the 4-hour coming into today, this might have confused some of you guys, but where is it? We actually ended up pushing higher and we swept this high and we were retesting into this 4-hour fair value gap this whole time, right? And the hourly formed past as well. So it would be like, oh, isn't this conflicted? The thing with the time frames is that the higher the time frame, the more drastic the move. That's why we had this massive sell-off here after we respected the 4-hour fair value gap. It's going to be a more drastic move, but it's going to be less accurate, which is why we can see price completely busting through this 4-hour fair value gap higher and then displacing lower and then still respecting it. And then since we're forming kind of this bearish narrative with the 4-hour, we have this fair value gap, and then hourly we're displacing higher, but then like the volume starts dying off a bit. We can see price soup this high and then waiting for price to react. We have this 1-minute order block getting formed, as well as price forming past the swing low, and then waiting for another candle for confirmation. We see price wick, there's this wick tapping into these two imbalances. Like we have the fair value gap and we have the order block, then we have the soup, and we also have the 4-hour fair value gap. From there, I would formulate a more bearish narrative from this, and I could take a bearish trade. But to be honest, the second one, I would recommend just going for this first one. The first one is a lot more clean, it's got more alignments. This second one is a lot more discretionary, I would say. But yeah, that is pretty much the breakdown of yesterday's trade. So I'm making this on the 21st. this trade was on the 20th. But yeah, that's essentially it for my model. Pretty much all I got. So thank you guys so much for watching. If you guys did enjoy the video, then please feel free to share some love down below. It is my first time making this type of video, so if you guys do have any feedback, if you guys do need to see a bit more explanation on a certain confluence or narrative or discretion or anything like that, comment it down below and I'll probably just go look at it. I'll probably make a video on it as well. So yeah, I really appreciate you guys for watching all the way through, and I'll see you guys in the next one. Peace.